Welcome to Outlook 2026. First, a few results of a comprehensive CNBC TV18 poll of top economists. India's GDP is expected to grow at 7.5% in the current year, FY26, but slow down to 6.8% next year. However, on FY27, there is actually a deep division. One half of the economists I spoke to said only 6.5% next year. The other half is over 7%. So that's why the average of 6.8. On CPI inflation, the average we got was 4% for next year, FY27. But here again, 50% of the economists said they expect it to be as low as 3.8%. 50% said over 4%. Current account deficit is seen at 1.06 next year, more or less unanimous. But the more important figure is the balance of payments, which is including FPI and FDI flows. That is, on balance of payments, average economists see a inflow of $7.6 billion. But again, 50% saw a much bigger figure of a 20 billion inflow. And of course, there are several who saw just a 1 billion or a negative. Rupee, a big majority expect the currency to be around 92 to the dollar. So not much movement by end FY27. Not much depreciation expected from here on. That was the economist's view. But to discuss the whys and hows of the outlook, we are joined by three top economists: Soumya, Kanti, Ghosh, Group Chief Economic Advisor of SBI and member of the Finance Commission. We have Mridul Saggar, former RBI Executive Director, former member of the MPC and now a professor at IIM Kozhikode, and Sonal Varma, Managing Director and Chief Economist, India and Asia ex-Japan at Nomura. Gentlemen, and Sonal, thank you very much indeed for your time. Let me start with the ladies. Sonal, I want to actually start with balance of payments first, because the rupee has given so much of a shocking decline in the last 4 weeks. Is your expectation that FPIs will finally turn the corner and start finding India attractive? Will we have a good balance of payments inflows next year?
Yeah, Lata, I think that would be our baseline. I think in the last 12 months, it's been more a challenge of funding the current account deficit in terms of less capital inflows. But the current account deficit for FY26, I mean, on our estimates, might end up being, closer to 0.6 to 0.8% of GDP. So it's fairly low. But of course, the challenge has been on funding. I think there are two things that potentially change over the next 12 months. Number one is essentially on the equity side of the story, where India did not benefit at all from this entire AI theme. Plus a big disappointment in terms of earning downgrade, US trade deal not happening. So we've already seen a significant underperformance of the Indian equity market, and currency has weakened. So as a starting point, I think the forward-looking outlook on growth is looking a lot better from here. So I think a lot of negatives are priced in, a lot of the positives are not. So yeah, there is potential for equity inflows to come through. Second is on FPI bond inflows. So there is a possibility that India could get included in the Bloomberg Global Aggregate Index. It's going to be a small weight, but potentially it can lead to over $20 billion in inflows. So if we combine that with the current account deficit that's around or less than 1% of GDP, I think the problem of funding this current account deficit should be less of a concern. And just one final point, I think the currency weakness we've seen both on absolute but also on a real effective exchange rate basis should over time also autocorrect some of the current account imbalance. This is particularly we've seen in the case of imports, which tend to come down as they get more expensive. So yeah, I do think things should improve as 2026 progresses.
Okay. Gentlemen, I will come to you all for the balance of payments and current account deficit, but I want to touch all the topics first and then go in detail. Soumya, on fiscal deficit, the nominal GDP has given us a scare, and there is a fear. Is there a fear that next year also the nominal GDP will be low? And because of that, can we have a fiscal deficit issue? Difficult to bring it down to 4.3 as our poll says.
Yeah, thank you, Lata, for having me on the show. I think regarding the fiscal deficit, I believe that the center has been on a positive glide path in the last 4 years. They have brought it down from 9.2 to 4.4% last year. And if all indications suggest, notwithstanding the pressures on the revenue this time, I think the expenditure tweaking and the expenditure switches and the expenditure compression possibly will ensure that India is well on its target to achieve the fiscal deficit target. And next year, I think we are looking at a target which is lower than 4.4%. But I am not expecting any deviation from the fiscal consolidation path. But I'll be also closely looking at the consolidated fiscal deficit, which has been progressively coming down over the years. And as the center has clearly pointed out, is that the debt to GDP ratio is now one of the prime targets. So if the debt to GDP ratio glide path, which has been laid out in the budget, is adhered to, I don't see, we are deviating from the fiscal deficit glide path, notwithstanding the pressures on the.
Okay. Soumya, I'll come to the debt to GDP part because hereafter we won't even be talking much about fiscal deficit goals. But what is the kind of borrowing you're expecting? In my poll, several people said the 10-year yield will actually go up to 6.6. There was a minority which said even 6.1 and 6.2. But do you think that the borrowing amount itself is likely to be high because there are so many tax giveaways and even the states are not collecting much?
No, yeah, Lata, I think the borrowing numbers we are taking into consideration if we're taking the center and the states
And
combined.
states.
Yeah, the total gross borrowing could be around 27 to 28 trillion. I think the net borrowing numbers could be significantly lower, taking into account the switches, the buyback which the government is likely to do. But in my sense, I think the number should be around 27 to 28, which is not significantly higher than this year.
My poll gave me 30 trillion actually. Because it
Yes.
is 27.7 this year, people are not actually penciling in close to 10%. And
Yes.
the argument was if it is 30 trillion, then there isn't appetite in the market and RBI has to do a lot of OMOs. What's your view on that?
See, I think the RBI has clearly made it that it is going to keep the NDTL at 1.5% of surplus. So that is around 2.5 trillion. So if I go by that number, I think the Reserve Bank will have to do some amount of heavy lifting next year also, because the appetite for the market and in terms of the switches of the papers or whatever is being done, we are expecting some reforms also in the GSEC market next year. But taking all this into consideration, I will not rule out an RBI OMO, which could actually be closer to around 1.5 to 2 trillion next year, as per our baseline scenario.
Okay, and 10-year could end the year at 6.6?
We are not significantly pricing in an upside in 10-year yield. We are expecting that the 10-year could actually hold at these levels, or it could trend marginally lower. But there may not be significantly downside to the 10-year GSEC estimate as of now.
Okay, so cost of capital doesn't rise much. Mridul, the more important question really will be CPI. Some of the respondents told us 3.8. Some are sitting over 4% for next year. That becomes very important even for the nominal GDP. So what is your best guess? Are we in for another benign year of inflation?
I think inflation should hover around the target, and that's not bad for the economy. So practically, we will see somewhere, I think the numbers you mentioned, 3.8 to maybe 4.2 could be the range where we will see much of the movement of the inflation next year. So I'm not too concerned about inflation at the moment.
Would you be concerned about nominal GDP?
So nominal GDP probably could still track 10.5 to 11% is my feeling. And
right. Nobody gave me 11 number at all. The numbers I got were 10 and 9.5. So, I have given an average of 9.7. But that is a big worry that our nominal GDP will continue to be a worry. This year, the average I got was 8.3. You don't think that will be the state next year?
So there will be sort of, at the moment, it does look that the growth is at risk. So there is considerable uncertainty around the growth, and we need to be cautious of that. But the baseline still looks that we can do around 7-ish.
Okay. Okay, then it's positive. 7 plus inflation of 4 will be very good. But Sonal, what is the view on Asian disinflation? Because our negative WPI is largely, I mean, we were advantaged by the 2 good monsoons, but core has also remained under control. What's the Asian disinflation or inflation scenario, and therefore what's your forecast for India?
I think broadly, Lata, the theme is still one of benign inflation across Asia. We do expect some improvement in domestic demand across countries, so output gaps will gradually close, but it takes time for that to actually lead to an increase in core inflation. And China, in fact, is slowing much faster than expected. The November Tier 1 data we had showed both retail sales, but also particularly fixed asset investment contraction continuing at a very fast pace. So that we think will actually continue to be a source of disinflationary impulse for the region. It should also keep commodity prices in check. So I think in general, we think inflation in Asia will pick up in 2026 because 2025 it's been fairly low across the board. But still very much within the target. So inflation is not a challenge in Asia. And I think the same's the story in India as well. Whether it's the domestic, wage increase, commodity input prices, and even with the currency depreciation, the tradable component of the CPI basket is very small. So the imported inflation pressures will be quite limited.
Okay.
The analysis we've done, Lata, actually shows that structurally the trend in super core inflation has come down from 5.5% in the last 10, 15 years to less than 3.5% now. That is a pretty major deal and does mean that even though we are talking about a 4% CPI, that's purely on account of base.
Okay. Very quickly, before I take the first break, Sonal, an out of syllabus question. What about this yen BOJ rate hike? The language sounded that there will be more. There was no disruption in the FX market now. But what is the in-house Nomura view? Should we worry about any disruption because of the yen?
Well, I think that's something to monitor next year because our view is, policy rates at 0.75% are still less than the sort of nominal neutral range. So if you look at the nominal neutral range for Japan, it's anywhere between 1 to 2.5%. So at 0.75%, we are not even at the lower end of the target range. So there is more normalization that is ahead. The question is the speed at which the BOJ will move and whether it'll be fast enough compared to market expectations. The challenge we see in 2026 is core CPI in Japan, which was propped up because of very high rice price inflation. That will actually move down. And so core CPI we see actually moderating below 2% in 2026 and staying below 2% in 2026. So the normalization continues. We think there'll be 50 basis point additional hikes. But we think they are more likely to be delivered in 2027 and 2026 may be slower. So that will have implications for yen as a result.
Okay, at least the yen is at peace now and the global markets are not, scampering because of the rate hike. A quick break and we have lots more questions on the macroeconomy in 2026. Welcome back to Outlook 2026 for the Indian economy. I've been speaking with SBI's Chief Economic Advisor, Soumya Kanti Ghosh, Mridul Saggar, former ED of Reserve Bank of India, former MPC member, and Sonal Varma of Chief Economist, India and ex-Japan Asia at Nomura. Gentlemen and Sonal, thank you very much for your patience. Soumya, to start with you, the big ask will be Capex cycle. The government will, what are you expecting in terms of government Capex itself? But more importantly, is private Capex really filling up the gap that government Capex may leave behind?
Yeah, I think the indications of the private capex cycle has been good in recent times. I think even if I look into our bank's project pipeline, the funding pipeline, the approvals, I think there are the private capex cycle has actually caught up. The pace of increase or incremental addition to the private capex cycle could be a matter of debate. But at this point of time, I think there are more positives than negatives on the private capex cycle, as we understand also from our bank balance sheet. And the second important point to note is that I think the government capital expenditure has possibly reached a peak at 3.2% and 11 trillion. If the upside to that government capital expenditure not look significantly on the higher side. From that aspect, I think we could see a compositional shift or maybe also a push towards the private capex from here on. And the only thing I can say at this point of time, that even if you look into the project announcements, even if you look into the across sectors, that looks healthy at this point of time.
Okay, so you're saying government capex cannot rise by this 25-30%. You're expecting what, a 5-10% rise in government capex?
Yeah, I think the moderation, that there'll be a moderation in the pace of the increase in government capital expenditure. I think at 3.2%, it can go up by maybe 10 to 20 basis points at the max, but not the type of increase which we have been seeing earlier.
Okay. Well, Mridul, do you want to comment on the private capex, any data that you have pointed out? And the other question I wanted to ask you was about the RBI will continue this benign liquidity, stance that it has adopted. So two questions, two separate questions.
Okay, so let me come to the first. I am seeing that the capacity utilization rates have now stayed above the long-term average for more than 13 quarters, but the Capex cycle so far hasn't really kicked up. But yes, as Soumya was pointing out, there is this incremental interest of the private sector to improve its Capex, and we hope that will translate. I think if global uncertainty comes down from here, that would be a significant booster to the Capex even in India. The government doesn't have much scope given that they will be entering into a tough fiscal period with the seventh pay commission a year down the line. So they can't really sort of do a lot of Capex, but if they maintain it in line with the nominal GDP growth, plus do a little bit of switching from revenue to capital, I think the job would be done with the substitution of private capex, substituting the fall or not so much increment in the government capex.
Okay.
Coming
RBI's liquidity.
To the RBI's liquidity, my sense is we are going to have a tough period next year, while the uncertainty of the global rounds seem to be receding now, but that could be just a small blip in some period because the asset prices are valued way high. And I don't know, people don't seem to be worried. I'm extremely worried when Case-Shiller cyclically adjusted CAPE ratios are 40 plus, even for Nifty it is 40 plus. So to expect a lot of equity flows might turn out to be difficult. And if some shocks come on the way, we could see a lot of volatility in exchange rates, a lot of volatility in asset prices.
You think that the chances of a negative BOP or actually outflows in FY27 also is a very live possibility?
There is a possibility. Live possibility means it's not the base case, certainly, but there is a possibility. And while I think at the moment, people are too concerned about the exchange rate. I am more concerned what might happen ahead. To me, 2025 was not an issue of exchange rate at all. While a lot of commentary I'm hearing, exchange rate has depreciated just by 5% on this calendar basis, or even fiscal basis, it's 5%. And that's not at all surprising. I mean, if I see from 1991, there are 12 years in which we have a higher depreciation of rupee in 12 out of the 33 years, we have seen a higher depreciation of rupee.
Yeah.
So, floating exchange rate, this to be expected.
No, I don't think it was the earlier depreciation that worried the market. It is just that from November 15th, after we got the October trade data, there has been a near 3% depreciation. So people are suddenly sitting up. It was not the talking point before November. It was just something we noticed, by the way. The anxiety is coming in now. But you're right that the Reserve Bank is right in allowing the currency to take the instability or the change, the disruption, and it's not changing its policy. That's welcome, but we will have to see whether they can continue with the easy policy next year. I take your point about asset prices. Sonal, on Capex, Capex is the big story. Growth will be the big ask. This year, there is a slight suspicion that the growth numbers are looking good because of the deflator. What about next year? Will there be Capex and will there be growth?
Lata, I think 2025 and FY26, while headline GDP growth, real growth has surprised on the upside. Actually, a lot of the cyclical components have disappointed, whether it's the tax component, earnings growth, some of the consumer discretionary side. So there's been this disconnect between the headline and the underlying trend. As we look ahead into 2026, we're expecting a reversal where some pickup in deflator leads to a moderation in the printed real GDP growth, which we still think will be steady and robust at 7%. But I think what's important is what is this underlying momentum going to be? And this cyclical momentum, which did slow in our view in the last 12 months, is the one we think will improve.
Okay.
So globally, actually, this year we've seen significant trade policy uncertainty. So next year, we think given US midterms, the trade and tariff-related uncertainty will be much less as the focus shifts.
Okay.
Second, India, we've seen tremendous monetary liquidity, credit, and currency adjustments, which actually is easing the domestic monetary conditions, and I think will be positive for the domestic cyclicals going forward. And the interest rates, in particular for the rate-sensitive components, for instance, like residential and housing investment, should also particularly be important. Government Capex, in our view, will be close to nominal GDP growth rate. So overall, the underlying components on growth should improve. With the investment pickup, more some of the interest rate sensitive components of investment.
That's a great point to end this discussion, that actually the tailwinds to growth can improve. 10 seconds for each of you. What is the one worry you may have for FY27? Soumya, very brief, please.
I think on the uncertainty and the external front, there could be some amount of headwinds.
Okay. Mridul?
Yeah.
The risk that the asset price bubble might burst on very weak global financial regulations that I am now seeing.
So both of you are worried about the external. Sonal?
Also external. I think the asset price bubble and any weakness in US labor market. So it's more the external spillovers than domestic that I would worry about.
Got it. We've worried about it this year, and that will continue next year as well. A look at the external markets. Thank you very much for joining us in this very special edition of Outlook 2026.